For days ago, silver broke $70. Today, December 30th, it's trading at $76. But if you think this is a bull market, you are looking at the wrong numbers. This isn't a rally. This is a crime scene. While the financial media is distracting you with headlines about volatility, a massive liquidation event is happening behind the scenes. One that is currently wiping out the liquidity of 5 major U.S. financial institutions. Stop looking at the spot price for a moment. Turn off the tickers showing you the green percentages. Those numbers are for tourists. If you want to understand why your bank might not open its doors next week, or why the repo market is suddenly flashing red warnings that we haven't seen since September 2019, you need to look at the other side of the trade. Every time a trade goes vertical, someone is on the winning side. Sure. But in the derivatives market, for every winner, there is a loser. And right now, the loser isn't a retail trader on Reddit. The loser is the very infrastructure of the American financial system. My goal today is not to tell you where the price is going. It's to show you why the banking system, the very mechanism that has controlled these prices for decades, has just officially failed. And why that $30 billion loss is just the beginning. I want you to look at this heat map of the banking sector I have on the terminal here. It's a sea of red. This isn't a coincidence. We are looking at real-time market data, and the timeline is critical to understanding the severity of this wound. Silver hit an all-time high of $79.11 just 72 hours ago. The disconnect between paper spot prices and physical reality has finally snapped, and the shockwave is tearing through the balance sheets of what we call the Big Five bullion banks. Let's be very clear about what we are witnessing. This is not a correction. This is not profit-taking. This is a solvency crisis masquerading as a commodity boom. To understand the magnitude of this, we have to go back to the start of the bleed. Back in October 2024, silver was trading in the $30 to $33 range. Felt expensive then, didn't it? But even at that level, the data suggests these 5 banks were already underwater on their short positions by approximately $1.3 billion. That was manageable. That was a bad quarter. They could hide that in the other comprehensive income line of their quarterly reports. They could shuffle assets, sell some treasury bonds, and cover the margin. But that was when silver was at $33. Today, we are staring at $76. Let's do the math that the mainstream networks are refusing to broadcast. The difference between $33 and $76 is $43. That is the spread that these banks are eating. Now, multiply that $43 loss per ounce by the estimated 708 million ounces of short exposure held by these commercial entities. The calculator doesn't have an opinion. The calculator says that is a loss of over $30 billion. $30 billion. To put that into perspective, that is more than the entire market capitalization of some mid-sized regional banks. That is enough to wipe out the Tier 1 capital buffers of a major trading desk. And that is just the loss on silver. We aren't even talking about the contagion effects on gold or the currency swaps that are likely tied to these positions. Now, I know what some of you are thinking. You're thinking, so what? It's just a paper loss. They haven't sold yet. They can just hold until the price comes down. This is the single biggest misconception about institutional trading. And it is why this situation is fatal. You, as a retail investor, can hold a losing stock for 10 years. You can ignore the red numbers in your brokerage account and tell yourself, I don't lose until I sell. Banks do not have that luxury. Banks operate in a world of mark-to-market accounting. Here is the mechanism that is destroying them right now, hour by hour. Every single day at the close of business, the exchange, in this case COMEX, looks at the closing price of silver. They calculate the value of the bank's position. If the position has lost money since yesterday, the exchange issues a margin call. They demand immediate cash collateral to secure the trade. This isn't a request. It's a requirement. When silver moves up $1, these banks collectively lose approximately $78 million. That means every single day silver rallies, they have to wire $78 million or $150 million or $500 million in cash to the exchange clearinghouse. This creates a liquidity drain. It sucks cash out of the bank's reserves. It forces them to sell other assets, treasuries, corporate bonds, maybe even stocks, to raise the cash to feed the silver beast. This is why we call it a liquidation event. They aren't buying back the silver yet. They are liquidating everything else just to stay alive in the silver trade. They are bleeding to death from 1,000 cuts, day after day, margin call after margin call. And this $30 billion figure? That is the estimated capital that has been incinerated just to keep these positions open. That is money that is gone, evaporated, transferred from the balance sheets of Wall Street to the accounts of the entities on the other side of the trade, and we will talk about who those entities are later. But the horror story goes deeper. We are seeing signs that this mark-to-market pressure is breaking the internal risk models of these institutions. Banks use algorithms to calculate value at risk, or VAR. These models are based on historical volatility. They look at the last 10 or 20 years and say, silver rarely moves more than 2% a day, so we are safe with this amount of leverage. But what happens when silver moves 5%, 8%, or 10% in a single session? What happens when the chart goes vertical? The models break. The VAR spikes. The risk management department screams, close the position. But the trading desk screams back, we can't. Why can't they? Because there is no liquidity. If you try to buy back 700 million ounces of silver in a market where no one is selling, you don't push the price down. You push it to the moon. You create the very spike that kills you. This is what we call a short squeeze. But usually a short squeeze happens to a hedge fund, like Melvin Capital in the GameStop saga. This time it's happening to the market makers themselves. The house is losing. The casino is out of chips. This is what I mean by a system failure. These banks are no longer trading. They are trapped. They are essentially hostages to the price of silver. And the market is demanding a ransom they cannot pay. Look at the headlines today. Silver rallies on industrial concerns. Solar demand pushes metals higher. They are sanitizing the event. They are trying to make it sound like a supply and demand story. And it is fundamentally, but structurally it is a leverage story. It is a story about what happens when you build a skyscraper of paper contracts on a foundation of sand, and then the tide comes in. We are watching the tide come in. The $30 billion loss is the debris washing up on the shore. It tells us that the foundation has already collapsed. We are just waiting for the building to fall. When a major financial institution takes a hit of this magnitude on a single commodity desk, it freezes their ability to lend. It forces them to contract. It makes them look at their other counterparties with suspicion. If I'm drowning, is he drowning too? This is how credit freezes start. This is how 2008 started, not with a bang, but with a specific asset class going no bid and balance sheets suddenly revealing giant black holes. The scary part isn't the number 76. The scary part is that the price is still rising despite the fact that these banks are desperately trying to cap it. They are throwing every contract they can at this market to suppress the price, to stop the bleeding, to save their capital. And it's not working. The market is absorbing their paper and asking for more. This is the definition of a broken market. The control mechanism, the ability of the bullion banks to dictate price through unlimited paper selling, has shattered. They hit the sell button and the price went up. That is the moment the machine became self-aware. That is the moment the paper market died. So we have established the scene of the crime. We have a $30 billion hole in the banking sector. We have a vertical price chart that indicates a total loss of control. We have a margin call mechanism that is draining liquidity from the system daily. And we have a media apparatus that is refusing to call it what it is, a solvency crisis. But this begs the most important question. These are not amateurs. These are the smart money. These are the institutions that wrote the rules of the game. How did they let this happen? How did they allow themselves to get so incredibly over-leveraged on a tangible asset that they couldn't print? You don't get into a $30 billion hole by accident. You get there by arrogance. You get there by believing that the laws of supply and demand don't apply to you because you control the supply of paper. So, how did the smartest guys in the room trap themselves in a $30 billion nightmare? The answer lies in a single terrifying ratio, 5 to 1. Wall Street calls it providing liquidity. I call it selling what you don't own. And today I'm going to show you the math that proves the vault is empty. Remember that $30 billion loss I just walked you through? It didn't happen overnight. It wasn't a sudden accident. It was a slow-motion train wreck that started back in October 2024, when these institutions made a calculated decision to refuse to cover their positions at $33. They bet that they could outlast the buyers. They bet that their deep pockets and their ability to flood the market with paper contracts would scare the dumb money away. But they weren't betting against dumb money this time. We need to look under the hood. I'm pulling up the CFTC's Commitment of Traders report right now, specifically the Bank Participation Report. This is the official scorecard of the crime, the regulatory filing where they are legally required to disclose their positions. And if you know how to read it, it tells you exactly where the bodies are buried. Look at the commercial short column. The data is staggering. The big 5 U.S. banks are holding a short position equivalent to approximately 708 million ounces of silver. Let that number sink in for a second. 708 million ounces. To put that into perspective, the total global mine production of silver for an entire year is roughly 830 to 850 million ounces. These 5 banks have sold nearly an entire year's worth of the planet's production into the market. But here is the problem. They don't own the mines. They don't own the refineries. And they certainly don't own the metal. Now look at the other side of the ledger. The COMEX registered inventory. These are the bars actually sitting in the vaults in New York that are registered, meaning they are fully warranted and available for immediate delivery against these contracts. It's sitting at just under 150 million ounces. Do the division. That is a ratio of nearly 5 to 1. For every single ounce of physical silver sitting in a vault in New York, there are 5 paper contracts floating around claiming ownership of it. It's a fractional reserve system applied to a hard asset. In a normal market, this works. It works because 99% of traders are speculators. They don't want 5,000 ounces of silver delivered to their driveway. They just want the cash profit. So, the banks can trade these paper claims back and forth, settling in cash, collecting fees, and never moving a single bar of metal. It's a confidence game. As long as everyone believes the silver is there, the game continues. But what happens when confidence breaks? What happens when the buyers stop asking for cash and start asking for the metal? This is where the trap snaps shut. Because you cannot print silver. You cannot create it on a spreadsheet. You cannot quantitative ease a precious metal into existence. The banks built this massive short position assuming that silver was just another financial asset like a treasury bond or a currency pair. They relied on their algorithms. And their algorithms made a fatal error. They assumed that demand was elastic. In Economics 101, you learn that when the price of something goes up, demand goes down. If steak gets too expensive, you buy chicken. The banks assumed that as they pushed silver to $33, $40, $50, the buyers would walk away. They thought the industrial users would switch to cheaper materials or cut back production. They were wrong. The buyers in this market aren't speculators. They are gigafactories. They are solar panel manufacturers. They are defense contractors building missile guidance systems. They are the backbone of the green energy transition and the AI revolution. These buyers are price inelastic. Think about it. If you are a solar manufacturer, silver paste is a critical component of your photovoltaic cells. It's a tiny fraction of the total cost of the panel, but without it, the panel doesn't work. If silver goes from $30 to $76, do you shut down your billion-dollar factory? No. You pay the $76. You scream about it, you hate it, but you pay it. Because the alternative is bankruptcy. We are seeing a structural supply deficit that has lasted for 4 consecutive years. The world has been consuming about 280 million ounces more than it produces every single year. We have been eating into the above-ground stockpiles to make up the difference. And now those stockpiles are gone. So, you have a situation where the demand is structural and desperate, and the supply is finite and shrinking. And in the middle of this collision, you have 5 banks holding 708 million ounces of empty promises. This is why they can't cover. If they try to buy back 708 million ounces in a market that has a deficit, who are they going to buy it from? The miners? They are sold out for months. The refiners? They are working 24/7 shifts and still can't keep up. The only way to get that much silver is to bid the price up until holders are willing to part with it. Is that price $100? $200? No one knows because we have never seen a squeeze of this magnitude on a strategic industrial metal. In 1980, the Hunt brothers tried to corner the market through pure speculation. They bought silver on margin, hoping to get rich. The regulators stepped in, changed the margin rules, and crushed them. The government said, "You can't do that," and the price collapsed. But in 2025, the banks are being cornered by physics. You cannot regulate away a physical shortage. You cannot pass a law that makes solar panels work without silver. You cannot change the margin rules to make a Tesla battery conduct electricity without the metal. The government can intervene in the paper market, sure. They can suspend trading. They can force cash settlements. But they cannot force the metal to appear in the vault. The short trap is mathematical. It is absolute. And the banks know it. They are trapped in a room with contracting walls, and the only exit is painted on the wall. Every day that passes, more metal leaves the vault. We saw 47.6 million ounces leave in just 4 days at the start of December. That is the bank run happening in slow motion. The industrial users smell blood. They know the paper price is fake, so they are draining the physical inventory while they still can. The banks are bleeding $78 million for every single dollar silver moves up. They are desperate. But here is the twist. One of them isn't desperate at all. In fact, one of them switched sides right before the crash. In high-stakes poker, the scariest moment isn't when your opponent raises. It's when the biggest player at the table quietly switches seats to sit right next to you. And that is exactly what happened on December 2nd. While the big five banks were drowning in that $30 billion loss I just showed you, the data suggests that one key player, or perhaps a faction of smart money within that group, decided to stop fighting the tide and start riding it. They saw the writing on the wall before anyone else, and they made a move that has effectively doomed their former partners. I'm going to reveal the specific data point that signals the short game is officially over, and why the price level of $85 will be the final nail in the coffin for the old system. Come closer to the screen. I want you to look at this chart from the CFTC. This is the bank participation report, specifically tracking the net positions of U.S. banks in the silver futures market. For 10 years, decade after decade, these bars have been red. Red means net short. It means that every single month, without fail, the aggregate position of the largest U.S. banks was betting against the price of silver. It was a constant. It was as reliable as gravity. They used their massive balance sheets to absorb long contracts, hedging their books by selling paper. It was the short machine that kept prices suppressed below $30 for a generation. But look at the bar for December 2nd, 2025. It's green. For the first time in recorded history, the reported U.S. banks category flipped to net long. Do you understand the gravity of this? This isn't a hedging error. This isn't a statistical anomaly. This is a complete strategic reversal. Even during the legendary price run of 2011, when silver nearly touched $50, the banks remained stubbornly short. They fought the rally all the way up and all the way down. But this time, right before the price went vertical to $76, they switched sides. Why? Why would the masters of the universe, the architects of the paper market, suddenly capitulate and go long? To understand this, we have to look at the concept of asymmetric information advantage. These institutions have a view of the market that we don't. They see the vault drainage rate in real time. They see the wholesale orders from Samsung, from Tesla, from the Chinese solar consortiums before those orders ever hit the public tape. They knew, probably months ago, that the physical inventory was reaching critical levels. They knew that the inelastic demand we talked about in part 2 was going to break the mechanism. So, instead of dying with the ship, they engaged a strategic pivot. History gives us a blueprint for this. Remember 2020? JP Morgan paid a $920 million fine, the largest in spoofing history, for manipulating precious metals markets. But while their traders were spoofing the price down, The bank was simultaneously accumulating the largest physical stockpile of silver in the world. They were playing both sides. They used the paper market to suppress the price so they could buy the physical metal on the cheap. The data from December 2nd suggests the accumulation phase is over. The insider has decided it's time to let the price run. This creates a terrifying scenario for the other banks, the ones who didn't get the memo, or the ones who were too slow to exit their short positions. They are now the bag holders. They are the ones sitting on the wrong side of that $30 billion loss. And the entity that flipped long? They are now profiting from the squeeze. This isn't just a market squeeze anymore. It's a cannibalization. The banking system is eating itself to survive. The smart money has exited the burning building and locked the door behind them, leaving the exposed institutions to burn. And if you are betting against this move, thinking silver is overbought, you aren't fighting retail investors anymore. You are fighting the banks that switch sides. And this leads us to the kill zone. We are currently trading at $76. The volatility is extreme, but there is a specific number that the risk models are flashing red on. That number is $85. Why $85? It's not an arbitrary psychological resistance level. It's a solvency threshold. Based on current open interest and the estimated capital structures of the remaining short holders, analysts project that at $85 per ounce, the realized and unrealized losses will exceed the Tier 1 capital buffers of the exposed institutions. Tier 1 capital is the core measure of a bank's financial strength. It consists of common stock and retained earnings, the money that protects depositors from losses. Regulators require banks to hold a certain amount of this capital to ensure they don't collapse. When the losses on a derivative position like silver execute a blow-through of the Tier 1 buffer, the bank becomes technically insolvent. They are no longer compliant with Basel III regulatory standards. This triggers an automatic regulatory response. It forces an immediate liquidation. This is the nightmare scenario for the global financial system. If silver hits $85, the clearinghouses and regulators will force these banks to close their positions immediately to prevent a total collapse. But how do you close a short position? You have to buy. Imagine a bank being forced to buy 100 million ounces of silver at market price, right now, regardless of the cost. That buying pressure sends the price from $85 to $100. Then $120 in a matter of minutes. It creates a limit-up spiral that breaks the exchange. But the damage won't stay in the silver market. This is where the systemic contagion kicks in. To meet that margin call, to plug that hole in their Tier 1 capital, the bank has to sell everything else. They have to dump treasuries. They have to sell their S&P 500 futures. They have to liquidate their corporate bond portfolios. So, a crisis in a relatively small market like silver suddenly triggers a crash in the bond market and the stock market. This is the definition of systemic risk. This is why the Federal Reserve is watching the silver price with sweat on their brow. They know that $85 isn't just a price. It's the detonator for a much larger liquidity bomb. The pivot on December 2nd was the signal. The smart money knows the explosion is coming, and they moved to a safe distance. They flipped long so that when the explosion happens, they get rich while their competitors get liquidated. We are watching a controlled demolition of the old fractional reserve pricing scheme. The paper market, which allowed banks to control the price for 50 years, is being dismantled by the very people who built it, because they realized it can no longer contain the physical reality. The game of musical chairs is entering its final round. The music is stuttering. The biggest player has already grabbed his chair. The other 5 are circling nervously, staring at the empty vault, hoping the music doesn't stop. But the music is about to stop. So, the banks have flipped, the vault is empty, and $85 is the kill zone. What happens to your silver when the exchange finally admits it has nothing left to deliver? When the music stops, there are only 2 outcomes. And neither of them looks like a normal trading day. We have seen the deficit, the trap, and the pivot. We know the vault is draining, the banks are cornered, and the smart money has already switched sides. Now let's look at your portfolio. Because when this system finally snaps, the difference between wealth and paper will be the difference between holding an asset and holding a lawsuit. I'm going to map out the 2 most likely scenarios for the next 7 trading days. These aren't guesses. These are based on the legal frameworks of the exchanges and historical precedents from previous market failures. Scenario A is what I call the Great Decoupling. This is the base case. In this scenario, the paper price on the COMEX might technically remain managed. The banks might throw their last remaining liquidity at the futures market to keep the headline price from hitting that $85 kill zone we discussed. You might see the screen price sitting at $76, or maybe even dipping to $70. But here is the catch. You won't be able to buy any actual silver at that price. This is where the physical price divorces the paper price. If you call a dealer to buy a 100-ounce bar, they won't quote you spot plus $5. They will quote you spot plus $50. Or they will simply say, "We have no inventory." We are already seeing this in the premiums. The spread between the paper price and the street price is the real inflation gauge. In this scenario, the paper market becomes a zombie. It's moving, but it's dead. It no longer discovers the price. It only discovers the level of manipulation. If you are holding physical metal, the paper price is irrelevant to you. Your net worth is determined by what someone is willing to pay for the metal in your hand, which will be significantly higher. Scenario B is the stress case, exchange force majeure. If the inventory drain accelerates and we hit 0 registered ounces, or if the price blows through $85 and triggers a systemic margin call, the exchange will intervene. They have the legal right to declare force majeure or an emergency situation. We saw a preview of this with the LME nickel market in 2022. When the price skyrocketed, the exchange simply canceled the trades. They halted trading. They changed the rules in the middle of the game to protect the clearinghouse. In the silver market, this likely manifests as cash settlement only. This is the ultimate rug pull for anyone holding paper silver. If you own an ETF that is not fully allocated, or if you hold a futures contract intending to take delivery, the exchange can simply send you a check for the closing price and cancel your contract. They will say, "Sorry, we have no metal. Here is your fiat currency." And this is the trap. You get paid out in dollars right at the moment the dollar is losing purchasing power against the metal. You miss the real move. You get your money back, but you can't buy the silver with it because the physical market has gone no offer. There is also a significant regulatory risk here. We cannot rule out government intervention. If the silver squeeze threatens the solvency of the big 5 banks, do not be surprised if we see a windfall tax on precious metals or trading halts imposed by the CFTC to maintain orderly markets. History teaches us that when the system is threatened, the rules are rewritten to save the institutions, not the individual investor. So, how do you know which scenario is playing out? Do not guess. You need to watch 4 specific signals this week. These are your dashboard for the collapse. Signal number 1, COMEX registered inventory. This is the heartbeat of the market. We are currently hovering around 150 million ounces. If this number drops below 100 million ounces, the panic begins. That is the psychological line in the sand. Below 100 million, the industrial users will panic buy everything left. I will be posting the daily vault reports on my feed, so keep a close eye on that number. Signal number 2, backwardation. This is a technical term, but it's easy to understand. In a healthy market, future prices are higher than today's prices. Contagion, because of storage costs. Backwardation is the opposite. It means the price right now is higher than the price next month. It means the market is screaming, "I need metal now." If you see the spot price trading higher than the futures price, the shortage is critical. The system is starving. Signal number 3, physical premiums. Stop looking at the ticker tape and start looking at the street. Call your local bullion dealer. Go to the major online retailers. If you see premiums spiking to 50% or 100%, or if you see out-of-stock notices across the board, the decoupling has happened. The screen price is a lie. The premium is the truth. Signal number 4, the Fed's discount window. This is the hidden signal. When banks are bleeding liquidity because of margin calls, they quietly go to the Federal Reserve's discount window to borrow emergency cash. They don't announce this on CNBC. You have to look at the Fed's weekly balance sheet data. If you see a spike in emergency lending to commercial banks, it means the contagion from the silver losses is spreading to the broader banking sector. It means the $30 billion hole is getting bigger. Silver at $76 isn't a bubble. It's the sound of the fiat matrix breaking. For 50 years, we have lived in a world where financial engineering could suppress reality, where paper contracts could dictate the value of hard assets, where banks could sell what they didn't own and pocket the fees. That era ended this week. The institution that falls today, whether it is officially declared insolvent or quietly bailed out over the weekend, is just the first domino. The math has finally caught up with the manipulation. The deficit is real. The vault is empty. And the people holding worthless paper promises are about to learn a very expensive lesson in counterparty risk. This is not financial advice. This is a survival assessment of a broken market structure. You have the data. You have the scenarios. You know that the smart money has already flipped long. The only question left is, what are you holding? I will be tracking the vault data daily. If we see a force majeure notice, I will go live immediately. Subscribe and turn on alerts. You do not want to be the last one holding a paper promise. This crisis in December 2025 is not merely about silver hitting a record price. It is a structural warning that the global delivery mechanism is struggling to meet its physical promises. Instead of reacting to the daily headlines, keep your eyes on the specific signals, like inventory levels and premiums, to distinguish between verified facts and paper speculation. Ultimately, when a pipeline is pressurized beyond its limit, the danger isn't just that the gauge goes up, but that the flow itself comes to a sudden halt.